These are coming in. Good morning, everybody. Welcome to our annual conference. It's a webinar today. It was a webinar last year. It's a webinar today, but we hope that it will be a proper conference like we have held in the last 14 years. And for those that know us, know Lawrence and myself, welcome back, and thank you for your attendance. For those that are fairly new to Sovereign and our annual conference or annual webinar, a very, very warm welcome to you all. Ladies and gentlemen, we have 385 registered attendees. Some won't be able to attend on the day, so we're just going to slowly canter through the introductions and to tell you what Lawrence and I are going to cover today. Like all of our annual private client conferences, pre-COVID at least, there was always quite a big element on the changing landscape of tax law pertaining to UK property. This is exclusively UK property assets, main residence, buy-to-let, commercial property for land for property development and trade. It applies to UK companies, non-UK companies, and in specific regard to non-domiciled individuals. So this is what we're going to cover. The presentation, ladies and gentlemen, perfected, will be sent to you separately, perhaps by tomorrow, or certainly before the end of this week. And there'll be plenty of time for questions and answers. So please raise your questions in the forum, and we'll try and answer one or two questions as we canter through each chapter. And there'll be a question and answer session at the end. So to start with, as we're still getting quite a lot of people enter the webinar, and still coming in, thank you very much for that. And still counting the numbers. We're coming up to about 200 now, so thank you very much, ladies and gentlemen. To introduce the speakers, my colleague Lawrence Lancaster, the Group Head of Tax of Sovereign Tax Services Limited. He once was very much part of my office and subsidiary. We're both directors up to 2018. Then Lawrence decided to go to Singapore, again to Singapore, and a loss to some extent to the UK, but this is what webinars are all about. So welcome back, Lawrence, barrister at law, Group Head of Tax, and myself, who will be trying to keep up with Lawrence. I'm the founding managing director of Sovereign UK. So rather than getting into the nitty-gritty too early on, let's just try to keep to time because this is a 1-hour webinar. Tiffany, if you could take down to the next slide, please. We've still got attendees coming into the forum, into the webinar, so thank you very much. We're not technically starting, so we're still on the webinar, the welcome, sorry, and the introduction. So again, a warm welcome to you all. These are the elements that we will be delivering today, ladies and gentlemen. We've got a total of 8 illustrations, 2 case studies, and it's a webinar of 5 parts, 5.5 if you count the welcome and introduction. The first is addressing the SDLT, the stamp duty regime, the 2% surcharge, the 3% charge, and the implications for structuring here. Part 2 is we're going to go on to some extent trust arrangements. This is a new expression, flexible property trusts, better known as a conventional offshore trust with particular planning, but flexible property trust is what we like to call it now as an industry term, and that's planning structures for personal use. A trust structured to purchase a UK property settled by a non-UK dom or a non-domiciled person, being an asset purchase in the UK but used as a main residence, not a buy-to-let, not a commercial, not a development sort of item. Part 3 is the structures that we tend to use for mostly non-DOMs, but they'll have UK DOM applicability. Again, flexible property trusts, QNUPs, that's qualifying non-UK pension schemes, particularly in Guernsey. And then we move into the realms of the family investment company planning, highly relevant, not just for property, but it is a property sort of show today. Part 4, we move out of residential property and deal with UK commercial property, again for UK structures, non-UK structures, UK DOMs, non-UK DOMs. Property development is what Lawrence is going to cover, and we're going to have plenty of time for questions and answers in part 5. There are scores of literature on HMRC websites, on law firm websites, but we're going to deliver 8 case studies, 8 illustrations, 2 case studies. Do raise your questions throughout. That will appear on my phone or second screen. There's now coming up to 200 delegates appearing and attending. There's still some to come in. So I think rather than wait any longer, we are on 9:05. So Lawrence, do you want to sort of start proceedings and addressing part 1, the SDLT regime that everyone's up against now, and investors of types? Lawrence Lancaster, thank you.
Yeah, thanks very much, Simon, for everyone as well for joining us this morning. So we're starting off today with the new SDLT surcharge that was introduced by Finance Act 2021. And as we say, as the window's shutting on the stamp duty window, with the exemptions that currently apply to the tapered rates of stamp duty, that window is closing shut. And just as that's closing shut, non-residents are now facing this new 2% surcharge, and it applies to all types of residential property where the value of the residential property being purchased is £40,000 or more. So if you can think, Simon, of any property in the UK for which you could buy for less than £40,000, I think you would struggle. So you might be able to buy a shed in London or something like that for £40,000, but then that wouldn't be a dwelling. But what you're looking at is any type of residential property which is bought for more than £40,000 by a non-resident. They will now be subject to this 2% SDLT surcharge. And the thing with it is, there's a special definition of resident. It's not just the case that if you're UK tax resident, you will not be subject to this charge. What the legislation actually says is that you have to have been, when you make the purchase of the property, you have to look back at the previous 364 days, and you have to have been physically present in the UK, including on the day of purchase, for 183 days or more. So if you think about it, many non-DOM clients who utilise the UK's remittance basis regime, often they weave their way around the statutory residence test and ensure that they're UK tax resident, but only spend 91 days in the UK, and they normally have 2 or 3 ties. Well, those type of clients will actually find that even though they're UK tax resident, they will be subject to the 2% surcharge because they are not resident for the purposes of this 2% surcharge. The other thing to note, it applies in addition to the 3% charge. The 3% charge is not residency specific, so UK residents and non-residents are subject to that charge where they buy a second property. Note with that 3% charge, it doesn't just apply where you own another property in the UK aside from the one you're buying. It's property anywhere in the world. So you will find if you are a non-UK resident client and you are buying a residential property now in the UK, if you own any property anywhere else, which most of our clients will, you're going to be subject to stamp duty at this progressive rates, and on top of that, a 5% additional surcharge. If you are UK resident, bearing in mind those specific rules of residency which apply, you will not be subject to the 2% charge. And if we just go on to, sorry, just a couple more points on the, or at least one more point on the 2% charge. In terms of the residency rules, you may find you have clients that buy the property when they do not satisfy the 183-day test. But if subsequent to the purchase, and I've got a couple of clients in this situation at the moment, they satisfy the 183-day condition in the 365-day period after the date of purchase, then they can reclaim the SDLT. So let's just say you bought a property today in the UK, 21st of September 2021. The first test would be you'd look back to the 21st of September 2020, and you would look in that 365-day period, including today, whether you've spent 183 days in the UK. If you don't meet that test, you then pay the 2%. But if subsequent to that, so from today to the 21st of September 2022, if you then spend the 183 days plus and 183 days or more in that time, then you can reclaim the 2% and amend the return. So just worth bearing that in mind. We can now move on to the next slide. So I'm not going to go through this. These are just the progressive rates of stamp duty. These apply to every person who buys residential property. So these will always apply. There was in the past, when Simon and I first started doing these talks, stamp duty planning or scheming was rife in London at that time. And there were a lot of tax avoidance schemes, which we were never involved in, but there were doing the rounds. I think it's now generally accepted that you will always pay your stamp duty if you're buying a residential property from a third party. Then these rates will always apply, be it an individual, a company, or a trust. The issue is going to be whether the 2% rate applies or the 3% rate. And later on in the talk, we're going to take you through a case study as to how you can legitimately plan around those 2 and 3% charges in certain circumstances. And we're going to take you through quite a common scenario where you can potentially plan around those. But it's now over to Simon, who's going to take us through the first case study on SDLT. And we've got a case study on Rex, poor old Rex, and he's clobbered with all three of these charges. And this illustrates how they work. Simon.
Thank you, Lawrence, and thank you to close to 200 people attending as well. There's still a few coming in, and we're only on slide 5, and this is the first of 2 case studies and the first of 8 illustrations. A very warm welcome to you all. Right, let's have a look at this case study. This gentleman is both non-UK resident, non-UK domiciled. He's called Rex, good continental name, and he wishes to purchase property for around 2 million. But he cannot complete until the 1st of November this year, so way past the 1st of October, so therefore not able to catch any SDLT reliefs and that sort of thing. Not that there would be a great deal on 2 million. So his SDLT position, ladies and gentlemen, comes in at a staggering 100, well, not quite staggering, but to start with, a fairly hefty £153,750. Circa 154,000, and that's calculated by the progressive rates, as Lawrence has indicated and illustrated on the previous slide.
Yeah.
The window for relief closes 1st of October. Rex hasn't even exchanged. He's going for an exchange and a fast completion. Now the 3% does apply, is on point, being the 3% surcharge, ladies and gentlemen, because the he doesn't own any other UK property, but he does own another property in another country in continental Europe. Not a UK property, but he still owns a property like a lot of people do in the world. So he falls within this 3% charge. And if he was to be relieved of this 3% charge, he would not to have owned any property worldwide, rental, family-owned property, or whatever that might be. So the 3% charge does apply, and the SDLT is calculated on the gross purchase price, which he will complete on the 1st of November, being £60,000. Difficult to get a mortgage for as well. The surcharge of 2% also applies, because Rex will remain non-resident of the UK. Rex runs an attractive international business and is fairly young, younger than me. So 40,000 in addition, of course, the 2% surcharge of being non-resident. So the grand total, ladies and gentlemen, on this rather sort of dreary and negative first case study, negative only because there's a total stamp duty of 253,000, which equates to about, the accountants in the room will agree, 12.65%. I did say many years ago when I started my offshore career, offshore being the MD of our HQ in Gibraltar, the good thing about UK property is it's never going to be a big percentage, or the stamp duty is never going to be a big percentage of the purchase price, unlike Spain, then Portugal, France. Unfortunately, we've overtaken them, and that's not good, but that's a useful case study to sort of set the scene, and we'll come on to the good and the nice stuff a little bit later. Now,
and also just worth bearing in mind that the rate of SDLT back in 2010, 2011 on this would have been a flat charge of 4%.
Yeah.
And look at what you're paying now. So, I mean, what would that be? £80,000 compared to 253,000. And just as we leave SDLT, it's just worth bearing in mind, I think, a couple of points. These 2% and 3% charges do not apply to commercial property. So with commercial property, it is just the progressive rates that apply. And the progressive rates are actually lower. And there are, we're not going to cover stamp duty in detail, but you do need to bear in mind the reliefs such as multiple dwelling relief and how that interacts with these 2% and the 3% charges. But just to keep it simple, with commercial property, they do not apply. And I think clients who are still looking to invest in UK residential property might look to, for investment purposes, might look to invest at the lower end of the market, where you find that the stamp duty, overall stamp duty bill is less. The reason being is that the progressive rates, you no need to go back to that, the previous slide, but the first £125,000 of worth of the consideration when you buy property is taxed at 0%. And then the next 125,000 is taxed at 2%. So if you can find a property, say up north for 250,000, you'll find that the stamp duty at the progressive rates, I think it's that £2,500, on top of which you've then got the 2% and the 3% if you're non-resident. But you'll still find that the overall rate is more manageable than poor old Rex, where I think the overall rate here was over 12%, wasn't it, Simon?
Yeah, it was 12.65. Right, we've got quite a lot of illustrations to get to, gentlemen, and Lawrence, I'm going to hurry you a little bit if you don't mind. So slide 6, please, Tiffany, and we're coming on to structures, the positives. Thank you, Lawrence.
Yeah, so just very quickly then on this, I'll just read through the notes. So all companies and all discretionary trusts are subject to the 3% surcharge, even if there is no other property held in the company or trust. The residence of the company or trust is irrelevant for the purposes of that 3% charge. I should just note discretionary trusts, their interest in possession trusts, different rules apply, and we're going to come on to that later on. For the 2% surcharge, it applies to all overseas companies and overseas trusts, all overseas companies and trusts. UK companies owned by non-residents are also caught. UK discretionary trusts, i.e. trusts with UK trustees, should not be caught, but they are still subject to the 3% charge, and of course the harsh regime, income tax and capital gains tax regime that applies to UK trusts. So it's unlikely that a non-resident client is going to want to set up a discretionary trust in the UK to hold their UK property through and not pay the 2% charge, because the consequences of that for other tax purposes is likely to be more punitive than not buying it through a trust. So I don't think that planning is going to be used very much at all. And watch the position of companies where you're buying property worth more than £500,000. Property must be let out to third party after the purchase to avoid that punitive rate of stamp duty of 15%. And please do note, HMRC police that very, very heavily, where you're buying a property through a company for more than £500,000, they want to see evidence and clear evidence that it was bought with a view to it being let out to a third party. And you need to have that on file, because they could well ask for that. If the 15% rate applies, then the 3% rate does not apply, but the 2% rate does apply. So you will find that if you've got non-resident clients buying through, or any client in fact buying through a company, an overseas company generally, and they are and it's not let out to a third party, and it's rent and it's bought for more than £500,000, the rate of stamp duty will be 17%. And just one final point on this, where you've got a non-resident buying through a UK company, there is a see-through provision. So although the UK company under general principles should not be subject to the 2% charge because it is UK resident, unfortunately you look through it and you attribute the residency to the beneficial owner, the shareholder of the UK company. So that planning does not work. As I say, discretionary trusts with non-resident settlers do work, but they're unlikely to be favourable because of all the other taxes you're subject to. So on that note, we're going to move to something more positive. Over to you, Simon.
We'll just take the first question before that, Lawrence. So thank you, James, for this. Thank you, James, for this question, but I think we've answered it already. Thank you, Lawrence.
I hope so.
What happened in the first case study for Rex, good old Rex, if the purchase was made by a UK company, we've got the see-through provisions, and Rex is non-resident, and therefore the surcharge would still apply. And then Costas, thank you very much for your question. Slightly more technical one, so I'll let Lawrence answer the more difficult ones, please. And is the SDLT applied cumulatively to current UK properties? I don't think so.
No, so it's effectively the way it works is if it's a residential property, you apply the progressive rates to it, and then you apply the 3% rate and the 2% rate to the whole value of the consideration per the example we've just gone through. So use that as a reference point for how it works.
Well, thank you, James, and thank you, Costas, being the first two questioners out of 200 people. Right, this is the first illustration. We move on now to part two. Still on part two, sorry. Flexible property trusts, FPTs. The application is trustee ownership. The further application is for a non-UK dom or a non-domiciled person, not a UK person. If it's a UK person, we will steer into UK persons later. This is for a high value main UK resident, not a buy-to-let, a main UK residence, and it has specific reference to non-domiciled persons, because non-domiciled persons are rather relevant to trust planning. So here we go. The objective of the exercise is to purchase a £4 million property in the UK, possibly towards my office location rather than my domicile being Leicestershire, for example. So a £4 million property is the objective. The advantages are the bottom left-hand screen. So there's the finishing brief. But there's a person like Rex who's non-domiciled of the UK, and he has decided, with the advice taken, to settle a trust into which the purchase funds SDLT, the rising challenge of SDLT, and the accumulation of 2.1 million is settled and transferred in this situation to an interest in possession overseas trust, not a classic discretionary trust. Sovereign have agreed in this case to be trustees. That could be any one of our 8 trust companies, but typically Guernsey and Isle of Man, can be others. And the beneficiaries, as requested by the settlor, will be the spouse, children of adult and infant age, potentially remote beneficiaries, non-family members. But the settlor in this case is still a beneficiary because the family do not want to exclude him, or the trustees, more to the point, don't want to exclude him in terms of having the enjoyment of the property. And if he's going to enjoy the property, or she, whoever is the settlor, they're going to be a beneficiary. But the settlor in this case is a class of beneficiary. He has the right to enjoy the asset. Of course, he's settled the £2.1 million into the trust. He has the right to occupy, but is excluded as a capital beneficiary, which really means if the property is eventually sold and they upscale, downscale, move away from the UK for whatever reasons, the contribution of if it is distributed by the trustee, the rest of the settlor should only be credited and distributed to the beneficiaries other than the settlor. So in this situation, with the interest in possession trust purchasing that main residence, unfortunately the SDLT charges that Lawrence has illustrated applies, but because of the way the trust is structured and the fact that this person, lady or gent, is non-domiciled in the UK, no lifetime inheritance tax charges, which might occur naturally if this person was UK domiciled. No ATED, ladies and gentlemen, because it's not a company, it's not an envelope structure that buys the property. There is no dreadful ATED, and the ATED charges, if they made the mistake of using a company as opposed to a trust, would be astronomical, and that would be a charge every year. There's no capital gains tax if the main residence relief can be claimed, which is usually a beneficiary, any one beneficiary living in the property for 90 nights a year, which is the case in this case study, because one or more of those beneficiaries are going to be living in that property for a fair amount of time per year. So CGT relief is applicable. 10-yearly charge does apply. It's an IHT charge, a charge that is paid or liable every 10 years, not every year, but every 10th year. But you take the value of the property less the mortgage. He's funded, or the settlor has funded 2.1. There's a nice bank, there's some nice bank funding of circa 50% loan to purchase. So on the 10th yearly charge, you take the value of the property minus the debt, and then it's roughly about a 6% charge and a tax charge paid every year. Good news, come the settlor's untimely demise, no inheritance tax. Come the demise of any one beneficiary or more than one beneficiary, no inheritance tax, and excluded property trust status reverts if the property is sold and cash is received. So good host of benefits on the left-hand side there. Why you would use that sort of structure, enabling the settlor to enjoy the asset rather than sort of wave at his family through the window and staying nice and holiday in or something. That really is the benefits and as portrayed on illustration 1.
And just a couple of points on this FPT planning. The key condition, or the key two conditions, in fact, for an FPT are firstly that the settler must be non-UK domiciled and not deemed domiciled, and secondly, overseas assets must be settled into it. So it starts off its life as an excluded property trust, but what it does is you then move into the relevant property regime because you invest in UK property. But the trick with these trusts, we're going through 4 different models that you can look at using, is that the trust is tailored for so it's the most tax efficient from a UK planning perspective, but it's those 2 key conditions. And just on this one, as it says in the last point, excluded property status does revert if the property is sold. So it can be sold at any time, and then overseas cash deposited in the bank account of the trust, which would be held overseas. That's then an excluded property trust once more. And just one other really common point with this, we always get questions that, well, we've got a trust, we've got 10-year charge coming up. Can we take out a mortgage against it and reduce the value, the purposes of the 10-yearly charge? Well, no, you cannot. That does not work. That was blocked by section 162A of the Inheritance Tax Act back in, I think, 2013 that came in. So it's really important with this plan that you take out the mortgage when the property is acquired, not subsequently.
Okay. Thank you, Lawrence. Great compliment there. There's a super question from Stephen here, but it's going to have to wait towards the end to buy some time. Thanks, Stephen, but it will get answered. And I know it's unfortunately you're probably right on that one. I'll come back to that in a minute. We're on. Have we got to the next slide?
Next slide.
No, that's it. Forgot the number there. Slide 8. Applicability here: non-domicile, personal, non-UK domicile. It's a main residence. It's illustration 2. So I'll canter you through the objectives. It's an attractive property, slightly less than the previous one, £2 million. In purchase price, there is the option for bank funding, and you'll struggle to get more than 65. That's why we always be a little more conservative and say 50% loan to value. Could you move to slide 8, please? Thank you. So bank funding optional and at a reasonable rate. Usually from working with my financiers, and they're in the webinar today, some of the 101, well, close to 200, over half of you. Thank you. They can arrange the bank funding for a non-dom, for a trust, and for us, which we'd call speciality lending. Here, the settlor is contributing the deposit and the costs, circa 1.2 million, settled from his overseas or her overseas account into a discretionary trust, not an interest protection trust, a discretionary trust. Common denominator, sovereign, are the trustees. The trust with bank funding, optional, purchases the asset, the £2 million asset, which is going to be a main residence, not rented to third parties. The beneficiaries, as you would expect, spouse, could be a civil law partner, and children if they so exist. But the settlor in this case, yes, he is not only non-domiciled the UK, he's non-resident the UK, not seeking to enjoy the asset. There is some elder children in this case study over the age of 18, adult age, which are either starting a career or still in full-time mature education. The settlor is excluded due to the fact that the trust is discretionary, which arrives at the benefits in the bottom left-hand screen, ladies and gentlemen. Yes, benefits of, there's no benefit in enjoyment of stamp duty with the surcharge of 3% and 2% applicable. It's once only. There's no lifetime inheritance tax, the 20% rate in regard to the contribution going into the trust, whether it's the full 2 million without bank funding or, but it still, in any case, would exceed the nil rate band, so no lifetime inheritance tax there. There's no ATED because, yes, the property is not being rented. It's not being rented to the trust, and a trust is not a company. So don't ever use a company for main residence purposes. Only use a company for buy-to-let situations and rented exclusively to third parties. We'll come on to that later. No CGT upon the property being sold for, I think property was going up 4 or 5% a year, if you believe some broadcasters. Certainly it's going up and rather than going down. So the property industry has enjoyed COVID immunity to some extent. So CGT may not apply, providing one of those beneficiaries can claim the main residence relief, usually by demonstrating that they're living in the property for 90 nights a year, and one of these beneficiaries clearly are enjoying the asset to a great extent. If the settlor unfortunately suffers an untimely demise, and the same with the spouse, God forbid any children that do not outlive the parents, then there's no inheritance tax, and excluded property status reverts if the property is sold, and the proceeds can be distributed to beneficiaries because the settlor in this case is excluded. If not, it'd be a gift with reservation and benefit problem. So those are the 2 examples, ladies and gentlemen: an excluded settlor, an interest in possession trust on the first illustration, and if Lawrence has nothing to, we're over halfway actually, Lawrence, so maybe we should canter on to your slide on slide 9 eventually. Yes.
Yeah.
Lawrence.
So this example, we're moving on to an example now that provides both SDLT and inheritance tax planning. And again, it's a flexible property trust. What we're looking at here is that common situation where you've got an overseas client, donor in this case, who has children who are over the age of 18 who are UK resident. Quite a common scenario. Normally they come to the UK to go to university, and they often are at university, postgraduate studies, or they're young professionals, and they want a property. Normally non-dom, non-resident settler is overseas, and certainly in this instance where we're using a trust, it's key that the settler is non-UK domiciled. If they were not using a trust, they could potentially do this planning by an outright gift to a child, but we're not going into that today. So again, with the FPT planning, it's key that the settler is non-domiciled and non-resident, and that overseas assets are being settled. So here, you've got 2 million that's going into an overseas trust, an interest in possession trust. And in this case, the settler is settling it into an overseas bank account that's been set up by the trustee. Settler is excluded as a beneficiary of this trust. Unlike the carve-out arrangement we saw in illustration 1 of FPTs, the settler is excluded as both a capital and an income beneficiary here. He is completely excluded. But the child who is over 18 and we're saying is at uni or a young professional, they are the life tenant and have a right to occupy the property for their lifetime. And then you've got other children who are default discretionary beneficiaries. As I've said, the settler's non-UK domiciled, the child is over 18 and life tenant, no 2% SDLT charge, no 3% surcharge. Planning, because the life tenant will be using the property as their main residence. It should also be possible to structure the trust in such a way as other beneficiaries can assume occupation in the future. So you can do all of that tailoring, just make sure you fall within the terms of the legislation. And the reason for this working is that the legislation says that with interest in possession trusts, you look at the residency status of the life tenant, not the trustee. So even though the trustee could be based in the Isle of Man or Guernsey, you don't look at the residence of the trustee, you look at the residence of the life tenant, and that they are UK resident. Now, with this type of plan, certainly for the purposes of the 3% charge, if the life tenant was under 18, then they would attribute the purchase to the non-resident, non-domiciled donor settler. But because the child is over 18, none of that applies, and you just look at their position. So for the purposes of the 3% charge, they don't own any other property either in the UK or overseas, so they tick that condition. And they're UK resident for the purposes of the 2% charge because they've spent more than 183, they've spent at least 183 days in the UK in the previous 365 days before purchase. There's no inheritance tax because the settler is excluded, but you would get the 10-year charge. It is a relevant property trust, but an FPT, because excluded property trust status reverts if the UK property is sold. Just before we leave this illustration, it is worth bearing in mind that it remains a relevant property trust even after the settler's death. The key to excluded property trust status reverting and for it not to be subject to those 10-year charges and exit charges is that the UK property is sold in exchange for cash, which is deposited overseas. And there is no exit charge or any sort of tax charge occurrence when that happens, possibly capital gains tax, of course, but certainly no relevant property charge problem if that planning is done. And you can do that sort of, a few days even before the 10-year anniversary, and that would still work. But we've probably got questions on this, I'd imagine, later, but I think quickly moving on, please, to the next slide.
Okay, so this is now, we're on to start of part 3. A couple of minutes, we're running a couple of minutes late, but we've had some 2 or 3 questions which we had. So please stay with us, and thank you for your questions to the 200 people that are in the webinar. Part 3, this is to do with residential property investment, not a property that one would specifically and personally enjoy. typically a buy-to-let residential property, still in this case for a settlor that is non-domiciled or non-UK domiciled of the UK. So moving swiftly now to part 3. The residential property investment, there could be one or more properties. It's probably not in the heavy grand areas of 4 million, but to justify the existence, you're probably having a net property assets of at least 1 million here to justify the existence of this elegant structure. So here we have a non-UK domiciled settlor who can or she can be a little more colder to the structure because they're not actually going to enjoy the assets. The property assets are going to be rented to third parties, possibly through an agency. No assets are to be enjoyed by the family, even if they lay unoccupied during a winter month or a cold freeze with or without gas. So that is not to be enjoyed by the property. It's more of a commercial arrangement on a buy-to-let opportunity. So the non-domiciled settlor is going to settle perhaps 35% of the purchase deposit. This could apply for properties all over the United Kingdom. Because we've been successful with our finance partners to obtain a 65% loan to purchase residential mortgage on this buy-to-let investment opportunity. So the 35% goes in, transferred to the Isle of Man or Guernsey company. Typically, I use these types of companies because banks in the United Kingdom, the Channel Islands, British Isles, and banks that are friendly to the UK property asset arena are preferring an Isle of Man or Guernsey company compared with a BVI or Seychelles company. You may even get better rates as well. I know that you can. So yeah. UK residential property, the objective is to be acquired by the overseas company with mortgage finance. But moving up the page, the beneficiaries can be the settlor's family, loved ones, non-loved ones, other parties, but the settlor is going to be specifically excluded because it's a discretionary trust. In any case, the settlor is not looking to enjoy any of the assets because they're going to be rented out. So the clear advantages of this is there's no lifetime inheritance tax going in. The ATED we're exempt from ATED. You still have to make the claim. You still have to make a claim that you are going to be exempt from ATED due to the letting exemption, because all of the properties are going to be rented to third parties, so there's no ATED, which starts at a very, very low threshold. Net rental income will be subject to UK corporation tax, currently 19%, so still I think the lowest in the G20, and that is likely to rise unless our economy does something supersonic in the coming years. And it is on net profits, ladies and gentlemen, because mortgage finance is deductible from the gross rental income, so full deductibility. And if you take the value of the assets on year 10 minus the mortgage finance, it could be an interest-only mortgage, typically they are, then the 10%, the 6% charge, which is I refer to as a 10-yearly charge, is controlled to an extent. So that's where you would use a double structure for a non-dom settlor investing in buy-to-let property. And we now move to Lawrence again.
And just quickly on ATED there, it is important to note that with the other illustrations before this slide, you're acquiring the property directly in a trust. Where you're acquiring property directly in trust, you've got no issue with the flat 15% stamp duty charge for properties worth more than being acquired for more than £500,000, and no issue with ATED. It falls outside the scope of those two charges. Whenever you're using a company and the value of the property is more than £500,000, you do fall within the scope of both of those charges, the 15% and the ATED. And you have to ensure effectively that you're claiming an exemption from those. And the key to that exemption applying is that the property is let out to a third party. And in relation to the 15% charge, it has to be let out for at least 3 years after the date of purchase. If it's not, and obviously you can have, as Simon mentioned, reasonable periods where it's not let out because you can't find a tenant, but it has to be set up with a view to being let out to third-party tenants. And if it isn't, and we do get this quite a lot, where the settler, sorry, not the settler, where a benefit, because he can't use the property at all because he's excluded, but where a beneficiary would say, well, actually, I want to move into the property. Well, if they did that within the 3-year period from purchase, you would be bothered with that 15% stamp duty. And obviously, if they do it at any time, then you've got ATED issues. So it's very important to note that with this structure, it is for third-party tenants, and the settler must be excluded. And that means that he cannot receive a benefit from that discretionary trust. It is set up for the benefit of children, or possibly their spouse as well, the settler's spouse.
Just that we've got quite a bit still to go, and we're only on slide illustration 5.
So we'll move on to QNUTs.
Yeah, that's you, sir.
Yeah, so this is again a reference slide. I'm just going to read through this. So QNUTs are overseas pension schemes which attract important tax exemptions. You've got the main one was for inheritance tax that we've referenced there. Generally, they're used by UK domiciles as an alternative to registered pension schemes, as they benefit, as I've said, from many of these statutory exemptions. But non-doms, they are becoming more attractive for non-doms now because of the changes to residential property that we're going through today. An important decision of the Supreme Court in HMRC and Parry and others confirms the availability of the Section 10 exemption where you're using pension planning. So effectively, what that means is when you're transferring assets into a QNUT, there should be no issue of a lifetime inheritance tax charge because Section 10 should apply, provided it is being used for general pension planning and it's not obvious sort of gratuitous planning for future benefit of future children. So it just has to be commercially justified. Section 10 should apply. Should only be used by individuals who need pension provision. If they are already sort of overfunded, so they've got other pensions of say £5 million and then they're putting in say 3 million into a QNUT, there's a danger that Section 10 wouldn't apply in that situation because it could be seen that they were intending to benefit future generations, and the purpose of setting up the QNUTs was the IHT exemption rather than to provide them with a pension, because why would they need a pension when they've already got huge pension provision? Always something to look out for. Guernsey Pensions can invest in a range of investments, including residential property, and also Malta Pensions can invest now in residential property. They didn't used to be able to, but they can now. Sovereign's QNUT jurisdictions are Guernsey, Isle of Man and Malta, but I think from experience the most popular one tends to be Guernsey, then Malta, followed by Isle of Man. Would you agree, Simon, with that? Yes. Oh, you're muted. Sorry, yeah. We've muted you.
Guernsey is Guernsey's favourite, and it's often used. There's a slide coming up. 70% of the QNUTs fund can be property portfolio, property asset led, with 30% on traditional assets. So yes, absolutely right, Lawrence. Yeah,
and if the QNUTs exemptions apply, then you've got, if the overseas scheme falls within the statutory definition, UK statutory definition of the QNUTs, then you've got all of these benefits. So it's exempt from the relevant property regime. The rights that the member holds in the QNUTs are exempt from inheritance tax. Also, very importantly, there's an exemption from capital gains tax where the property is owned directly by the QNUTs and not through an underlying company. The QNUTs are trusts, so they fall outside the scope of the annual tax on envelope dwellings, and certain types of QNUTs are exempt from parts of the DOTAS regime, which I'm not going to go through today. But very, very important exemptions there. So we're going to quickly move on to a case study now, which is still me. And yes, so you can see here, you've got this, what we're illustrating here. It's most likely to be a non-domiciled settler here, but you could equally have a UK domiciled settler. Cash goes in, but equally you could transfer in an investment portfolio as an in-specie contribution. And what we're looking at here is investments in residential property. So you've got the member there who is the settler and also the member. And then in the pension context, we refer to beneficiaries as dependents. The reason for that is that with pensions, you have sort of two different sets of rights. You've got lifetime rights to benefit from the pension and death benefit rights. And with QNUPs, the member, the settler, is the person who has the right to completely benefit during their lifetime. And it's those rights that they hold which are exempt from inheritance tax on death. It's important, though, that in terms of death benefits, that the member ideally is excluded as a beneficiary there, the member's estate, and that you just list beneficiaries. And I normally say here, children should be listed as beneficiaries. The reason being, you often see a spouse that's included as a beneficiary of a QNUPs, and it's like, well, what planning is that giving you? Because if you're non-domiciled or UK domiciled, and you're leaving the asset to a spouse who is UK domiciled, you will always get the spousal exemption. So the QNUPs is not really providing you with any type of IHT planning, and of course the principal purpose for which it's set up is pension, but obviously we all have to accept that inheritance tax is a factor for using this. Now, if the spouse is the beneficiary, then that's not giving you any planning at all. So I would always say that you exclude the member's estate as a beneficiary, and you have the member's children and grandchildren, if they've got any, as beneficiaries. And you can change the beneficiaries over time. So that's very, very flexible, that aspect of it, and that you can change them without tax consequence. You've got to have a passive portfolio of normally listed investments of at least 30%. So we normally say the maximum is 70% that you can have of property, but there's no sort of hard or fast rule here. It's based on a prudent man principle. So just whisking through the tax benefits, sorry, the tax treatments. There shouldn't be any inheritance tax entry charge, the 20% charge. Watch though if the member is UK domiciled. If they're UK domiciled, you may need to fall back on section 10, and that's where you've got to be able to show it's set up for the benefit of the member and not their heirs. If the member is non-UK domiciled, there shouldn't be any issue with the entry charge if they're settling in overseas assets, because that's excluded property. SDLT at the progressive rates plus the 3% surcharge, and also now the 2% charge, unfortunately, as well. The reason being is that the QNUPs is non-UK resident, the QNUPs trustee. There's no way you would be able to argue that an interest in possession or any of that applies here if the member were UK resident. That's not going to work. But do note that you've got planning with existing property that can be transferred in without stamp duty if there is no mortgage. So that's something to bear in mind. Now, here is always the snag with QNUPs. You've got rental income that is taxed at 45% if the property is held directly by the QNUPs. But if the property is held directly by the QNUPs, you've got a capital gains tax exemption, a statutory gains tax exemption. Now, one thing to consider here is that corporation tax is going to go up to 25% in 2023. So you have to think that if you're using a company, okay, at the moment it's 19%, going to go up to 25%. And also you're able to reduce taxable income by taking out a mortgage, which in the pension context, you could take up to 50% of the property's value out as a mortgage. So it may be that it's shifting towards direct ownership with QNUPs now, rather than through a company, in order to obtain that capital gains tax exemption, which you get with direct ownership. Now, obviously, the holy grail with this would be to have the best of both worlds, where you get corporation tax rates on the rental income, so at the moment 19%, and the capital gains tax exemption. And it may be possible that you could structure the QNUPs as a carve-out type arrangement, whereby property income is vested in a company, but all the other rights are held by the QNUPs directly. But I think that type of planning, while it should work technically, is susceptible to DOTAS and GAR risks. So in the day and age, you would want to just be keeping it simple, I think, possibly now direct ownership in a QNUP to ensure that you get that capital gains tax exemption and the inheritance tax exemption on death. Just one final point on this. The exemption on death in relation to inheritance tax does apply if the property is held directly in the QNUP or through an underlying company. That is a question that crops up quite a lot. So you will always get the inheritance tax exemption if it's held directly in the QNUP or a company. So probably again got some more questions on this later on, but I think we're now on to the next slide, and Simon.
Yeah, staying with QNUPs, and we're on illustration 6 of 8, closing a little bit, and we've still got family investment companies to deal with. Lots, as everyone is present in the webinar. Thank you, ladies and gentlemen. Applicability, yes, UK DOMs, deemed DOMs, and as Lawrence mentioned, potentially others. Here is a situation where there is a buy-to-let investment portfolio being acquired, and not wanting to be exposed to a 45% income tax charge on net rental income, the client and his advisors prefer to be taxed at the corporation tax level. So we have a portfolio acquired by an offshore entity. That's the end result. There's mortgage finance, so the interest can be deducted from gross rental, further controlling the extent of taxation being paid. And in this case, going from the reverse backwards, the offshore entity is assigning its shares, allocating its shares capital to the, in this case, in this illustration, it was a Guernsey qualifying non-UK pension scheme. The member injected a reasonable amount of capital. We knew that we were going to get a pretty good mortgage, circa 3% loan to purchase price, sorry, 3% interest only rate at a 65% loan to purchase. The QNUPs, technically the settlor that injects the capital is awarded membership of that pension scheme, so he or she became a member, and the beneficiaries classically in this situation was the spouse, children, and others. The benefits, as we're getting some questions, which I want to at least answer one before we go to family, before we go to part 4. No lifetime inheritance tax going in, which wouldn't be the case if it was a UK domiciled person settling a trust. ATED letting exemption, because the offshore company is renting property to third parties, not to family and friends and closely connected persons. IHT relief and exemption should apply. Net rental income, done that. Any gains from the sale, currently 19%, because the QNUPs is not owning the property portfolio directly. There was a question even last night from an associate, and he wanted to, it was on the train, so I had to be a little bit careful how I answered it, on the train home to Kent, and he said, when will capital gains tax go up? When will it converge into income tax, and what's going to happen? I felt like I was on question time. Capital gains tax may go up, but I don't believe it's going to go up to 45%. But anyway, that's another subject. No 10-yearly anniversary charge, unlike a trust, and full deductibility of mortgage interest. So if capital gains tax is going to go up, which it might, I think it will go up to a cross-border level of 28% on all gains, not just property gains. Non-property gains 28%, so I predicted last time, but Rishi wasn't listening. I think it may go up. I don't think it will converge onto income. That will drive away business. So there's another reason why you just may use a QNUP directly to own residential property, as corporation tax and capital gains tax is going to probably increase, or at least corporation taxes. Lawrence, we've got one question, and the question is on buy-to-let residential property. That's where I've got to answer it, if just in case James has to drift to a meeting. If you need to draw the rental income from a trust, so you've got a company owned by a trust, not QNUPs, and for living expenses, apart from the corporation tax you pay on net rental income, thank you, James, will the distribution paid to a beneficiary be taxed? Well, I suppose if you're non-resident of the UK, it won't. If you're UK resident, you might.
Yeah, so there you would, if you're non-UK resident and you've got a beneficiary of a discretionary trust, a distribution from that trust will not be taxed in the UK. You do just have to watch under one of the matching rules, that's section 87, is subject to the temporary non-resident rules. So if you've got someone who was UK resident, non-resident now, and then becomes UK resident within 6 years, within 6 tax years, then they may be taxed to claw that tax on their return. But if they're not within the scope of those rules, then no problem at all, as long as they're non-resident for the whole tax year of distribution, even though the underlying source of the income is UK source. Remember that a distribution from a discretionary trust is a separate source of income. In relation to UK residents, if it's an income distribution, then it's taxed under general principles. If it's a distribution of capital, it's taxed under the matching rules. But if the recipient is a non-domicile beneficiary, then they do have the remittance basis potentially available to them. So if they're eligible to claim the remittance basis, they could, and obviously if they've been UK resident within 7 years or within 8 years, then they could claim that without paying the remittance basis charge, distribute out and keep the money overseas, and then there wouldn't be a tax charge. Okay.
We've got 2 more case studies. Change the slide, please, Tiffany. We've got 2 more case studies, sorry, 2 more illustrations of case study. We've had 5 minutes of questions. We're running about 10 minutes. There's way over 150 of you. We will canter through this. The presentation is going to be recorded, and a link to that recording is going to be available, and the presentation is going to be sent to you in its perfect form. So, Lawrence, canter through this, please, if you.
I'm just going to read through this. Again, it's one of those reference slides. So, if we've got a standalone company, if the property is commercial and the beneficial owner, the shareholder, is non-UK domiciled, typically they'll want to hold an overseas company such as Isle of Man or Guernsey for inheritance tax planning, because the shares that they hold are still excluded property. If a UK domicile is holding the company shares direct, there is generally no advantage in using an overseas company, particularly if that UK dom is UK resident. If the property is residential, a UK company will now typically be preferred for UK DOMs and non-DOMs, as the running costs are lower and there's no need for third-party directors such as Sovereign. For non-residents, there is no difference, as dividends from a UK company and liquidation proceeds are not taxed. So if you've got a non-domiciled client and they're happy to take the IHT on the chin, or indeed take out life insurance to cover the bill, then you would then just use a UK company. But if they want to put in place some IHT planning, potentially CGT planning as well, then you're going to be looking at some form of wrapper. So here you would be holding the overseas company if you're using a wrapper such as a pension or a trust, which we've gone through previously, then you would want to be using an overseas company as a general rule. I've got one of these inquiries on at the moment from a non-domicile client, and they're trying to use a UK company to save costs. And I'm telling them all, no, it is still better where you've got a pension on top, or as we say, a discretionary trust, to use an overseas company. The main issue with the UK company is that if there's any UK resident beneficiaries of the trust, or a pension, any UK resident beneficiaries of a trust, or a pension who are UK resident, then this causes dividend income to be subject to tax at a withholding tax of 38.1%. So that withholding tax applies regardless of whether you've got using a pension as the wrapper or a trust. So the issue there, you'll get withholding tax if either the settlor or any discretionary beneficiary is UK resident. Now, there is a technical issue with QNUPs as to whether a dependent of the QNUPs would cause the 38.1% rate to apply where the member if the member is non-resident. My view is it probably doesn't apply, but it's not worth taking the risk. So again, in this instance, if you've got UK property and you're using a wrapper, you're better off having an overseas company, because that ensures when the dividend is paid to the wrapper, be it a trust or a pension scheme, the source of the income is non-UK source. Whereas if you use a UK company, it's UK source, and you're potentially into that 38.1% tax. And as I say, with discretionary trusts, if you've got a UK company, you're going to have relevant property charge issues as well. So that hopefully gives you, as a sort of hard and fast rule, if you're not looking for any real planning, you use a UK company. If you are looking for IHT planning, and it will mainly be IHT planning, then you'll want to be using an overseas company.
So let's go to family investment companies. And Lawrence, you to explain. I'm doing the case study.
Yeah. So non-UK domiciles investing in residential property can no longer obtain inheritance tax benefits by using overseas companies. That planning was blocked in April 2017, but they can still use that planning for other UK assets that are not residential property, including commercial property. FPTs are good for personal use, but they do have the drawback of relevant property charge exposure. So flexible property trusts, as we've been discussing in detail before, are good for personal use, but they do have that the 10-year charge exposure. FICs should not be subject to the relevant property regime for the simple reason that they're not trusts. They allow the donor, who's the equivalent of the settler, to exercise control over the arrangement, and in certain cases to continue to draw funds. And that's either by loaning funds in and withdrawing the loan from the company, or in cases where you've got non-residents using this, they can potentially have preference shares in the company, but you should not use preference shares if you've got UK resident donors, because then you turn the company into being a settlement, a trust. HMRC have concluded in their examination into FICs recently that FICs are reasonable tax planning. So that's really, really good news for everyone. There were some concerns with FICs over the last couple of years that HMRC were going to clamp down on them, but they've looked into it and they're happy with them. And I think that partly may be down to the fact that corporation tax is going to go up soon. So they're quite happy that these companies are going to be paying some more tax. They rely on the principle that the company, the interests in the company shares carry 3 different rights. So income rights, capital rights, and voting rights. And shares themselves only need to carry at least one of those rights. So you can have a share which is voting, but doesn't carry the right to capital or income. And you can structure your shares really how you want to. An ordinary share will normally have the right to all 3 of those things: capital, income, and voting. So gifts of shares to other individuals should be potentially exempt transfers, not immediately chargeable transfers, which you get where you transfer assets into trust. And finally, shares that split between family members reduce the total value of the assets held by the family. So where you add up the total value of the shares, that's often a lot less than the total value of the assets held by the company, because you're splitting it up. So that gives you further inheritance tax planning. But the key principle here is that the donor, normally the person who's injecting the capital, will typically retain voting shares, giving him control, often in conjunction with a trustee. He'll often hold the shares, or she will often hold the shares with a trust, but the capital and income rights are transferred to the children or grandchildren. But they are complicated FICs, and there is a lot of traps and pitfalls. Now, the case study Simon's going to take you through now has been structured in such a way as none of those traps and pitfalls should apply, but great care is needed with FICs.
Thank you, Lawrence. The last 3 slides, ladies and gentlemen, is the final case study, which I'm talking about now, and then 2 snappy illustrations to conclude the main part. So here we have a transaction involving £5 million, and due to the lower annual costs of a UK company going forward, it could obviously be a lot less than that. So more the better, but less is possible, and the fixed fees will apply. So you've got £3 million of the client, the donor, being contributed into the UK company as share capital, £2 million as a loan, unsecured, an arrangement between the donor and the UK company, so he or she can get that loan back. Often it's an interest-free loan, but it can be either. And the UK company's objective is to undertake an impressive residential property investment. At the outset, because the contribution going in by one single person, the donor, the client, is allocated with A and B shares. This donor is non-resident and non-domiciled, and at the end of step one, they acquire the A and B shares, causing the company to make that attractive investment in UK residential property. So the donor holds the A shares, voting. The donor holds the B shares, capital income, and I believe non-voting, Lawrence. And the loan of 2 million is an interest-free loan repayable on demand. I've sort of said that. We move to step two, and the donor will gift, is a fit chap like me, not the youngest, but certainly not the oldest, but getting on a bit. Step two, the donor gifts all the B shares to the children, because they're the shares that enjoy the capital rights as well as some income rights, and 20% of the A shares, because that's the way he wants to sort of plan the succession.
And if I could just chip in there, that I had a question on this the other day as to why does he give away 20% of the A shares? What's that about? Because I think there's a common assumption, and it's the wrong assumption, that the voting shares have no value because they don't carry the rights to capital and income. The problem is that if you keep voting shares and you're able to pass special resolutions, and that normally allows you, and that will normally be the case where you have at least 70% of the voting rights, you're able to change the mens and arts, amend the articles of association, and alter the rights to shares. So it's vital that you structure this in such a way that the donor does not retain those rights to be able to amend the mens and arts. So for that reason, he has to give away some of the voting shares, and you need to structure the articles in such a way, generally requiring unanimity, to be able to then change the articles of association. And what that means is what you've achieved is the value of the voting shares that he's kept alone. And that is key for the inheritance tax planning to work. It doesn't have to be 20%. I've just sort of plucked that as a figure. But you do need to bear that in mind as one of the traps with FIC planning.
Okay, so always we'll do the practical. We'll also can organise council rulings on this, and a lot of the audience has their own council that they can rely on as well. But once it's structured, it's an excellent, elegant arrangement, because there's no IHT usually, because a person like myself is going to survive 7 years after gifting the shares to children and other parties. Let that donor survive 7 years, take the personality out of it, I suppose, and then providing they survive 7 years, there's not going to be any IHT on the value of the voting shares retained. And I think either a person like myself would want to still have at least, is it 70%, Lawrence? I think you said.
Yeah, I think that the value of the voting shares is going to be low for IHT purposes. Much lower than the value of the assets in the company.
Of course, and we've got to look out for. This is why the tax advice is so important. Gifts, reservation of benefits, pre-owned assets tax, transacting securities, settlement care. Tailored. It's not so tailored once it's sorted and the advice is there and the company just continues to run on like a regular traditional UK company, but the planning on the front end is very bespoke, very tailored. But at the end of the day, ladies and gentlemen, it's a UK company and not expensive to maintain going forward. I think we've still got 150 in the room, Lawrence, and people are lifting to their next meetings. And we've only got 2 illustrations, and they can be snappy, ladies and gentlemen, before we get a couple of questions which have come from Jacques. Hello, Jacques. Good to see you back. And also from Matthew. Thank you, Matthew. Coming to you in a second. Now, this is part 4, ladies and gentlemen, a slide I often like to deliver because there's I've got a lot of experience, a lot of case client action in this slide. And for once, thank God, it's not a residential property or residential dwelling, not a buy-to-let or a main residence, which is exposed to those terrific rates of stamp duty. My goodness. The budget coming up. Let's hope they don't do anything more with it. I think that's the 21st of October, Lawrence, but subject to confirmation on that one.
Yeah.
This is illustration 7, the penultimate illustration. This is a commercial property, a non-residential dwelling. It could be 40 Craven Street, where I am today, the office, sorry, a warehouse, a hotel, a factory, just business premises that you can't ordinarily live in, although we do spend a lot of time in our respective occupations. Here you can take a fully managed VAT registered Isle of Man company. The Treasury in the Isle of Man allocates and issues a VAT number indistinguishable to a UK VAT number because it starts with GB and it has 8 digits after GB. So to all intents and purposes, it is like a UK VAT registered company, although it's the Isle of Man Treasury that issues it. Fortunately, it's the Isle of Man Treasury because they can issue these numbers within 10 working days on the subject of giving them details of the property purchase, usually the real estate particulars. And therefore, if the buyer, the Isle of Man company, is going to buy from a VAT registered freeholder or the building is VAT pinged, VAT elected, you don't want to suffer VAT on the purchase. So if the vendor is VAT registered and the Isle of Man company is VAT registered, it's a transfer of going concern and no VAT will be on point. Isle of Man companies and VAT numbers acquired in 2 weeks. It's a commercial property, so the maximum progressive rates of stamp duty is 5%. No 3% surcharge, no 2% charge, none of that progressive rates of stamp duty that is unfortunately in place for residential dwellings. Corporation tax at 19% is suffered on net rental income. Yes, you'll get between a 50 and 65% loan to purchase finance. Deductibility of mortgage interest allowed. It's likely to be 4+% on commercial property, looking at the indicative rates. Because it's a commercial property, there's no bite and there's no see-through provisions as yet on the UK IHT, and I'd invite the Treasury and the Chancellor to keep IHT away from commercial property because it's a good barometer of the economy and we want the economy to thrive and prosper. So keep off IHT. We've had a lot of IHT collection in the last number of years. Statistically, receipts getting higher and higher is quite absurd. When in most other countries, inheritance tax is coming down because they're vote winning type of scenarios. Anyway, less on the politics. Careful of indirect disposals, rebasing there. And if you are a bit of a nervous disposition and worried about what the Chancellor may do next, although I think he's had a good COVID, the Chancellor, unlike the Prime Minister, I would have a non-dom setting up a trust to own an Isle of Man company, and for a UK dom, I would look at the application of a QNOS. You could also rearrange the shareholdings in the Isle of Man company into a sort of family investment type of arrangement. And it is, thank you very much, Jerry, it is the 27th of October, 4 days before my son's birthday, which is the budget. Thank you for reminding me. That's cantered through penultimate slide. Lawrence, can you do the same in the same speed for property development, please? Here we go. Still 135 left.
Yeah, so with this structure, what we're looking at, and I should clarify actually that it could be residential property that's subject to a development. The thing is with property development, as most of you will know, it's subject to income tax, the profit, rather than capital gains tax, but it may well be that dwellings are being constructed and then sold on. What we're saying here is essentially that the purchase is being done through a UK company. Previously with property development up to, I think, 2016, it was possible to use Isle of Man or Guernsey for this type of thing, and to rely on the tax treaty between the UK and Isle of Man or Guernsey, but that was blocked then. So I think now you would just typically use a UK company, but if the investor who typically is non-resident is going, and in this example they would need to be non-resident, rather than actually injecting the capital directly into a UK company, what you can do is set up a finance company and what we're saying here is in either Hong Kong or in Malta, and effectively they would loan the funds into that company, and then the funds would then be loaned on to the UK company with a small margin kept within the finance code, so it's subject to some tax in the case of a Malta code, not in Hong Kong, but it would have some profit that would be taxed in the case of Malta. So just take, and obviously the advantage of that, I should go on to say, is that 2 points. When the UK company comes to pay repay the interest to the finance company, that is a deductible expense for corporation tax purposes. But if you did not use this type of planning and you just had a normal individual making the loan in, typically that interest would then be taxed in the UK because it is UK source income. But what you're doing here is relying on the tax treaty, in one instance Hong Kong and the other in Malta. If you are using Hong Kong though for this, you do have to have a local connection with Hong Kong. I think if you've got a Southeast Asia based client, then you could justify using a Hong Kong company, but what you can't do is really have treaty shopping here. If you've got someone with no connection to Southeast Asia and they're setting up a Hong Kong company, then I think that's going to be caught. And in both instances, you have to claim the relief here. It's treaty relief you're relying on. So in order to ensure that there isn't that 20% withholding tax in the UK, you have to put in a HMRC claim, and they do want quite a lot of information on that. So that is just worth bearing in mind. But it is those 2 points, that it's a deductible expense for the UK company, the interest payment, and UK withholding tax can be planned around successfully by using a finance company that is registered and resident in a treaty country. And what we've got here is Hong Kong and Malta. I think with Malta, there's still more flexibility, a bit more flexibility there than with Hong Kong if you don't have any connection to Malta, which most clients won't. I think I've gone through most of these points. In terms of just picking it up onto the ATED point, there's the important development exemption there. So we've been, in the previous examples, you've got the residential property buy-to-let exemption, the letting exemption. In this one, what you're looking at is the development exemption from ATED. I've already been through the points about the treaty benefits, and just the last point there, just watch those new economic substance requirements in BEPS. I was looking at those the other day. The UK has actually implemented BEPS now in its treaties, but it hasn't implemented, it hasn't incorporated all of the BEPS provisions into its treaties. But it's just another thing you have to watch with any of this type of area. But the basic principle, I think, here, if you can draw one, is that you use a UK company for property development, and you look to actually structure the finance of that, the finance that's used for that development in the most tax efficient way.
Okay, thank you, Lawrence. We've got way over 100 in the room, so thank you again for your undivided attention, ladies and gentlemen. I'm just going to leave you with that reference slide. The presentation in its perfect form is going to be circulated, distributed by email. This sums it up on what we've talked about. On the left-hand side, grey and red, you've got the asset type, UK main residence, buy-to-let residential property, residential dwelling, property development, which Lawrence has just covered, and at the bottom, the UK commercial property, which is a positive breath of fresh air. The first two columns going across to the middle is what non-DOMs should do and their tax rates and advantages. And the last two columns is the tax landscape, because it is a landscape type of show for UK domiciled persons. That's an up-to-date property grid and a useful reference document. Next slide, and we'll go quickly as we got way over 100. Thank you, ladies and gentlemen. There was a recording of this show, and there is the presentation we're going to send to you. So if we can, on the obvious questions, Lawrence, which need, well, obvious answers to very good questions, could we deliver this snappy? We've got 3 or 4, and then people are going to have to get back onto their day. Matthew, are discretionary trusts charged advanced inheritance tax? No, because there's no entry charge, lifetime inheritance tax charge from the outset, as long as the settlor is non-UK domicile, as well as every 10 years. Well, there's a 10-year anniversary charge. Do you just want to clear that one up quickly, Lawrence? From James?
Sorry, what was the question?
Are discretionary trusts charged advanced IHT at the outset? No.
No. So it's when there's 3 main problems with a discretionary trust. If you look at a UK domicile from a UK domicile perspective, the first is you've got inheritance tax on the way in, which is the IHT entry charge, taxed at either a rate of 20% or 25%. If the settlor is the person paying the tax, you actually pay the rate of 25%. So to get the 20% rate, you actually have to have pay the tax. That's the first issue. The second is the periodic charges, the 10-year charge, and then obviously the exit charge as well. And the third is on the settlor's death. Unless they're excluded as a beneficiary, then you've got a tax charge on the value of the trust under the reservation of benefit provisions, that you do get a credit for that original tax that you paid on the way in. They're the 3 issues with UK DOMs. If you've got a non-DOM, then you have absolutely no issue on the way in, because you ensure that what gets settled into the trust is excluded property. So if you're looking at cash, that would be a cash held with an overseas branch of a bank. So it would be disastrous if you've got a bank account with, say, HSBC on the Strand, and you put in £2 million into a discretionary trust as a non-dom. That would be subject to the 20% entry charge, because the asset going in would be UK situs, being cash held in the UK bank account. Provided the account is overseas, then there is no entry charge. And equally, where you're dealing with other investments, say you're dealing with shares, as long as the shares are held in an overseas company, then the transfer of the shares to a trust will not attract the 20% entry charge, provided the settlor is non-dom. But again, you often see traps there where you've got clients with, say, HSBC shares, and they forget that HSBC is a UK company. They think, oh, I can transfer those into trust. Well, no, that's going to attract a 20% charge, because it's a UK situs asset. So it's vitally important with this planning that you check the situs of the asset that's going in, and obviously the domicile of the settlor. But in relation to the other 2 problems, the 10-year and exit charge, well, we can't do anything about that, even if the settlor is non-dom. But do note the planning that we discussed previously, where you can sell the UK asset and convert that asset into cash held overseas. As long as that's done before the anniversary, then there's no charge. Thirdly, in relation to the reservation of benefit rules, well, we plan around that in one of 2 ways. One is excluding the settlor. That's the most robust way of dealing with it. It must be done that before, well, from the trust's inception, really. If you exclude him after the property has been acquired, he would need to survive, or she would need to survive for 7 years to avoid an inheritance tax issue. So you've got to get these structures right from inception. And obviously the other way around the reservation of benefit problem is to do the carve-out planning that Simon took you through earlier. So hopefully that answers.
Right, we've still got over 100, but once we get under that, people need to go. We've got a super question here. Well, Devish, thanks very much for your remarks. He's got to go, and is fairly confident that Rishi won't increase inheritance tax rate, or maybe he circulates in better company than I do. Thank you, Devish. Here we are. What is Jacques? Hi, Jacques again. What is the capital gains tax rate for a UK non-dom who is currently non-resident selling his, well, he says main UK residence, but as his non-resident, capital gains tax applies effective from 2015, and I believe the rate's 28%, Lawrence, isn't it?
Yeah, so there you would look at firstly what their UK income is. So if they have no UK income, then they would have some of the gain tax at the rate of 18%, but that's only until the 20% income tax band has been exhausted. So you'd have, say, 37,000 of the gain falling within the 18% rate, not very much. And then the balance would be, as you say, Simon, taxed at 28%. Also, do note that non-residents do get that annual exemption, 12,500. So the calculation would be first 12,500 taxed at 0, the next 37 odd bit taxed at 18%, assuming no UK income, and then the balance, most of the gain taxed at 28%.
Okay, we've got to wrap this one, Lawrence, because this came in a bit early in the morning, certainly early in the innings. Thank you, Stephen. I moved to Portugal under the non-habitual residence regime. I know a lot about that, as does Lawrence, because a lot of British people and Europeans are welcome to move to Portugal and enjoy that major low tax Portuguese residency regime. Dividend income not taxable in Portugal, and pensions only taxed 10%. I will be non-resident in the UK for tax purposes. Yes, make sure you do, please, Stephen. What fate worse than death, being resident in both countries, but he will move to Portugal and be Portuguese resident, Lawrence. I'm planning to purchase properties owned by my companies into my name. Well, steady there, Stephen, because he's got property owned by a company, pre-existing assets. He's thinking of moving them out.
By a UK company.
He'll be non-resident, and he'll have those surcharges for SDLT. But it looks like, he says, it looks like we're going to be caught by those stamp duty provisions. Pre-owned assets, moving out of a UK tidy little company, bearing in mind dividends paid from a UK company to a Portuguese resident under the Portuguese non-habitual residence regime will not be subject to any dividend tax in Portugal. Lawrence, closing in on that one, please.
Yeah, well, I think the position is, if it's the company that's selling, if I understand the question correctly, if the company is selling the properties, then the company will be taxed, subject to gains tax, potentially, corporation tax on the gains in the tax year when it sells the properties. But then that's the first point. But secondly, then when the dividends get paid out, there won't be any withholding tax in the UK because the recipient is non-resident individual. And then the dividends are exempt in Portugal under the NHR regime. The only thing to watch there would be the temporary non-resident rules. You need to ensure that you're non-resident for more than 5 tax years, and that generally means that you've got to do 6 whole tax years of non-residence to avoid the dividends being taxed if you resume UK residence within that 6-year period.
Okay, right, thank you. And we do have to wrap up in a second. Thank you. Was there one other question? What would happen in the first case study if it was done in a UK? Oh, well, we answered that. There'll be the law see-through provisions. Yeah, sorry about that. What about overseas foundations? Don't like them for UK asset purchases and UK connected trade and permanent establishment reasons. Foundations are not recognised by HMRC and Treasury.
Well, they're not under UK law that we don't recognise foundations, so you have to then fit them in the category of either a trust, a company, or a nominee arrangement. And for most tax purposes, they fall within the definition of a trust, but not always. And you're just creating another obstacle for yourself and setting one up because you're having to deal with the issue of characterisation, which you don't have if you just set up a company or a trust.
Sonia might be UAE resident, but still UK domiciled. So setting up a DIFC foundation, I would not advise Lawrence to do that.
Well, did you say they're non-resident but UK dom?
Yes, sir.
Yeah, so they'd be subject to the IHT entry charge of 20% there if what they put in is more than 331.
Sonia, I would use a family investment company and have to talk to you about that separately, but don't use a foundation for UK inward investment. It's not a good idea, but thank you for the question. I think that's all the questions. We've just dipped under 100.
Yeah.
Next slide, please, Tiffany or Jess or whoever's on there. If you've got it, if you've not, we can send it. So I'm just going to wrap up now. That's effectively what we do, if it's not already clear. Everything that we've talked about, we do. You can get the greatest advice from the greatest law and accountancy firms in the world, but someone's actually got to go and do the doing in the practical. And half of that, trusts, companies formed in all the major onshore, midshore and offshore centres, that's what we do. That's what we register them, we manage them, we administer them. The same for trusts, the same for private trust companies. Even experienced investment funds, regulated funds, have a steer towards the property industry. We've covered UK property purchase on all assets, solutions for retirement with QNUPs, that has property nexus, insurance policies for property, family office establishment. It does have a steer towards property because 20% of our client base of this organisation is very much involved with the property sector, both in and external to the UK. Sovereign are now in their 34th year. Unlike the landscape of trust and corporate services providers, we're regulated as a trustee in 8 jurisdictions. We have 9 trust companies as a total complement. We have offices in 23. We have 23 offices worldwide, represented in nearly 20 different countries, and we're still under independent ownership. We're not owned by a private equity house. We're not listed on a stock exchange. We're a bit old-fashioned and straightforward, which is why we're quite good at what we do. Then again, you would expect that after 34 years. So next slide, Tiffany, as we close in. These slides are going to be sent to you, ladies and gentlemen. There's our contact details. Lawrence in Singapore, one day he'll come back. And myself, as you've got to put up with me in the UK, you get my details at the top there. And any situation which we've addressed in the questions, any situation you want to share with us, we will always give a positive recommendation, a map of action without obligation. So thank you for your undivided attention. There's still nearly 100 with you. Carry on with the questions. We'll answer them offline, online, offline. Thank you again. And we've had about 20 minutes of questions. That's why we've overrun a little bit. On behalf of Lawrence and myself, thank you again. The recording and presentation will be distributed to you. And here's the next one. Thank you again, ladies and gentlemen, and have a very good day. All the best.